This is the Asia Trade. I'm Shery in Tokyo. These are the top stories this hour. Risk appetite returns as investors bet the U.S. will clinch trade deals with top economic partners. President Trump also boosting sentiment by denying he plans to get rid of Fed Chair Jay Powell.
It's a perfect time to lower the rate, and would like to see our chairman be early or on time as opposed to late. Late's not good.
Mr. President,
I don't want to talk about that because I have no intention of firing him.
Tesla shares jumping in late trade despite a profit miss. Elon Musk says he'll pull back from his work with the government next month.
And I'm Stephen Engel at day one of the Shanghai Auto Show, where, of course, Trump's tariffs across the world will be top of many of the participants here. We'll be getting the take of a number of executives, including top executives from Pony AI of China, as well as Geely and Zeekr, coming up on, as I said, day one of the Shanghai Auto Show.
And of course, in China, we're watching the offshore yuan holding steady despite a strong rally in the U.S. dollar. We're talking about strong gains after falling to that 15-month low, and a lot to do with really more positive sentiment, not to mention that the dollar had been oversold. We're watching right now the Japanese yen also lose about 1% against the U.S. dollar. We have seen a stronger Japanese yen weighing on the Japanese markets right now. Nikkei futures pointing to the upside of more than 1%. We are also getting the Australia PMI numbers at the moment coming in firmly at 51.4 for the composite number, the manufacturing number 51.7, preliminary numbers for the month of April, services also 51.4, and this really to do, of course, with what's happening globally in the manufacturing services sector as well. We're going to get those first indications of the impact of President Trump's tariffs this month, and we're watching the U.S., Europe for those PMI numbers as well. We had seen the S&P 500 already seeing the best rally in about 2 weeks, and really to do with that more positive commentary coming on the trade side, also on those comments by President Trump in the after-hour session I mentioned earlier. Tesla really rallying after Elon Musk also said that he would be allocating far more of his time to Tesla as well. President Trump now saying that he has no intention of firing Fed Chair Powell, and that really adding to the broader risk-on sentiment across markets. Take a listen.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. If he doesn't, is it the end? No, it's not. But it would be good timing. It could have taken place earlier. But no, I have no intention to fire him.
Let's bring in our White House reporter, Hadriana Lowenkron. Hadriana, why the change in tune from President Trump?
These comments that he just made really, appear to contradict previous statements the president himself has made, as well as some of his key economic advisors. I mean, just last week, the president said in a post on True Social that Powell's termination cannot come fast enough. It's been a couple of months. Earlier, he had said something along the lines of him perhaps doing a better job as Fed chair than Powell. So we know that he has expressed continued frustration with the rates. And so this was something that appeared to be a 360. We're still looking into what may have caused this. Is it because he's looking at the markets? Is it something else? That is something that we are looking to figure out here, but definitely something that appears to have contradicted previous statements.
Especially also when it comes to trade negotiations with China as well. We are seeing this back and forth when it comes to negotiations with Beijing. Take a listen first to what the president had to say about those talks.
We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high. I think we'll make a deal with China.
We have seen Beijing really remain defiant when it comes to these trade negotiations. Do we have any indications at what level these talks are at this point? Well,
the president has said that things are positive in the trade front without directly answering the question of whether he has spoken to Xi. And it's something else to note, of course, is this comes after Bessent suggesting that this, is essentially some sort of embargo. And the question posed to the president was whether 145 would be, whether that would remain, and he seemed to suggest that it would be lower than that. So there's still some uncertainty here, and definitely we're seeing that play out in the markets, but we don't have at this point any definitive answer as to what a lower rate would look like, or definitive answers as to the exact status of these trade talks, although we know that the president has touted that there are several countries, his aides as well, that are coming to the table, and that is something that we're continuing to press on.
Yeah, and Secretary Bessent, it seems, when he was off the record in a closed-door event talking about the possibility of 2 to 3 years for a deal to come through with Beijing. Are we seeing a little bit of a divergence on what Washington is telling the public, their stance when it comes to Beijing, behind closed doors and in front of the camera?
Right. I mean, this is something, and we, I had done some reporting earlier, just generally on the differences in tone and the different verbiage that is coming and messaging coming out of the White House with regard to even the economy writ large. At some point saying that there's going to be, things are going to take time, or we're in a transition period, or I'm not looking at the markets, then I am looking at the markets. And so these are things that we're really trying to drill down in our reporting to accurately convey that there has been some different messaging, and really, trying to do our best to explain that to the public as they are looking at the markets changing day to day. So that is definitely something that we're looking into in terms of the differences here. And we see that with that reporting of my colleague earlier today.
Bloomberg's White House reporter Adriana Lowenkron there with the latest on the Trump administration, and of course all of those measures, the uncertainty coming from the trade war, already starting to impact global growth. The IMF Managing Director Kristalina Georgieva now saying that the chances of a global recession will rise if all of this uncertainty over this U.S.-led trade war continues to drag on.
If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret.
For more, let's bring in Garfield Reynolds, who leads our Markets Live coverage. Garf, I mean, it's not surprising that they would downgrade the growth outlook, but at the same time, visibility seems to be so poor depending on how all of these tariff scenarios could go. So when it comes to investors trying to allocate assets, what will they be following?
Well, I suppose they'll be following President Trump's social media feed more than anything else. We've just had what's been a risk-positive day in the U.S. with, first of all, Scott Bessent's comments about China and Trump's comments about China, and then Trump's comments on Powell, all representing a step back from some of the worst-case scenarios that had multiplied over the previous days. But every investor is going to be aware we're only a tweet or two or a Truth Social post or two away from a fresh reversal. Nothing that was said marks, is a sort of like makes it set in stone that the worst has passed when it comes to concerns about Federal Reserve independence and when it comes to concerns about the trade war. And when they're saying that 145% tariffs on China are not going to be the final amount, well, what is, and when will we know about that, and how will China respond? All of that makes it very difficult for businesses and for investors to work out, what their next steps should be and what the steps after that. And I think it's interesting that the dollar extended what had been a good day, overnight. In the early trading in Asia, it roared higher against the yen, the franc, the euro, and gold, all of which had been the havens of choice amid trade war chaos. Most of those moves have lost momentum. I mean, there were sizable moves this morning. they've been losing a bit of momentum lately. Investors have to be pondering, okay, is this a good time to get back out? Maybe we're in positions that we're wondering if we should get out of them or not, but this has given us a better exit point. Or are we going to hang tough where we are? Because where do we go from here, and how long can you rely on any move in this environment?
Even the sell dollar momentum really fading, we are seeing this strong snapback when it comes to the greenback. I mean, was this inevitable, or are we going to see a continuation of that narrative of sort of sell America trades that we have seen in the last couple of weeks?
Well, I think that's going to be the skew towards that, unless we get some really serious series of trade moves and a more considered approach to policy out of the White House, out of the Trump administration. Maybe some rhetoric about how, okay, we've inflicted enough pain for now. This is a time to consolidate and work together. Something like that might reassure investors. But so far, the second Trump administration has been a wild roller coaster ride. So every time, to extend the metaphor, every time you climb back up one of the hills, that there's a big drop that's coming. So you better hang on to your seats.
Bloomberg's Garfield Reynolds there with what to expect from the markets. We're also watching one stock, Tesla, jumping after hours. Elon Musk saying he'll pull back from his work with the U.S. government beginning next month. Bloomberg's Dana Hull joins us now for more. Dana, you can just hear the cheers from investors at this point. Tesla gaining more than 5% in the after-hour session. But I wonder if we have discussed the potential of permanent brand damage on Tesla. What have we seen so far in the performance of his business?
Well, the first quarter sales were terrible. They were down 13% from the quarter a year ago. But on the earnings call today, Musk kind of blew past that. From the jump, he basically said that his time allocation with DOGE will drop significantly, and he sort of blamed the bad quarter on seasonality. He said that people don't like to buy new cars in the winter, and that Tesla consumers are not immune from the macro, which is, uncertainty just with the economy in general. He also talked a lot about not being a big fan of tariffs, and said that he's kind of made his position known to the president, but is not the president.
Yeah, I mean, a very difficult position for himself to be for him to put himself in, actually. So the fact that we continue to see this ongoing rivalry between Beijing and Washington, and the fact that Tesla also operates and has a big business in China, are those some concerns long term for his business?
Yeah, I mean, I think he's trying to thread the needle. Tesla was the first and only automaker, as far as I know, who has a joint venture, in Shanghai with that big plant where they did not have to kind of partner with a Chinese company. But at the same time, they are dependent on China for a lot of their supply chain, particularly the LFP batteries for the Megapack and some of the actuators for the Optimus robot. So they are not immune to the tariff war. And, Musk, as the CEO of Tesla, he's got long relationships in China. I think he's really trying to thread the needle of, not angering Beijing, but also making moves to kind of onshore the supply chain as much as he can in the regions where they operate. And they've been at that for quite a long time.
I mean, Musk has been trying to put a positive spin on his business, right? That the future is brighter than ever. Where does that future lie in terms of products, not to mention regions?
Well, he's always going to do that. I mean, every earnings call, he kind of talks about the fabulous future. At this juncture, it's all about AI, the launch in June here in Austin, Texas, of autonomous ride sharing, Optimus robots. I mean, going forward, Musk doesn't think that people are going to be buying that many cars. But at the same time, they are trying to make their cars more affordable. They are going to come out, or they say they're going to come out with cheaper versions of the Model 3 and the Model Y. And, investors are cheering. I mean, after hours, it's up more than 5%. I think people are just relieved to hear that his kind of intense focus in Washington with DOGE is coming to a close.
The stock itself, I mean, it's fallen more than 40% just this year already. Could we expect some investors to come back in on the cheap?
I mean, I don't want to predict what the market is going to do, but I think you certainly have a segment of retail investors who buy the dip. I think there is a lot of concern about the macro environment in terms of interest rates and tariffs. If there's any clarity from the Trump administration about that going forward, you could see people coming in off the sidelines. It's been a very volatile period, as everyone who has a 401k knows. But I think that, Musk was sort of reassuring. I mean, he addressed the brand damage and his time with Joe's straight from the jump in his prepared remarks, and then went to questions.
Dana Hull, always good to have your insights. Tesla, of course, right now gaining ground in the after-hour session. Coming up on the Asia Trade, we discuss Japan's attempts to seal a U.S. trade deal with former Minister Taro Kono. Bernstein also joins us to talk investment strategy. And Aegon Asset Management tells us where they're seeing opportunities in the EM debt markets. We have much more ahead. This is Bloomberg. The 21st Shanghai Auto Show begins today with the Trump tariff war hanging over an industry already grappling with a slowdown in demand as it transitions to electric vehicles. Our chief North Asia correspondent, Stephen Engel, is at the venue and joins us now. Steve, what will be the highlights this year?
Well, of course, the Chinese say that rain on a wedding day is auspicious. I'm not so sure about a divorce, though, because it sure looks like there's some irreconcilable differences between China and the United States with those tariffs upwards of 145%. That will hang over, of course, the discussions here, while the Chinese automakers, of course, are looking at the possibility of finding other export markets beyond the United States. They might have to shelve plans for the United States given the threats of those tariffs right now. So we have heard that the Europeans and the Chinese have begun at least preliminary discussions on a minimum price mechanism, possibly replacing their tariff regime. But clearly, a lot of these automakers here and the parts suppliers will be looking at other markets around the world. They're not as large as the United States, and the United States automakers do rely on parts from China. But if you look at the number of the dozens and dozens of different automakers here in China, who, by the way, most are not profitable on the new energy vehicle front. They are looking for markets in South America, Southeast Asia, the Middle East, Africa, and the like. The big question is, how can they do that? How will they do that? And will that lead to a wave of consolidation, as profitability is still a big issue here? One thing that has changed dramatically over the last 2 years after the pandemic. So we were here in Beijing at the Auto Show last year, dominated by the new energy vehicles from the likes of BYD. The big hot car was the SU7 from Xiaomi, a mobile phone player that got into the mobility, the automobile space. This year, it will be a very similar story with the Chinese players dominating, because right now the foreign participation, the foreign automakers make up just a third, about 32% of the car market here. That's down from the heady days of 60% or so back as recently as 2020. So we're at half the level of foreign car penetration in this market. There's only one foreign firm in the top 10 leaderboard of new energy vehicles, and that's Tesla. And even their market share, Shery, has dwindled down to just 5.6%, with just 32,000 or thereabout of exports from their gigafactory here in Shanghai, the lowest number since that gigafactory opened.
Yeah, and it's perhaps not going to get easier with the ongoing trade tensions, but you also mentioned, of course, the challenges domestically that these car makers are facing, whether it's a profitability issue, or even issues with their autonomous vehicles as well.
Yeah, that autonomous driving, the self-driving issue is a big one here, even to the point where regulators here are advising, not even advising, mandating that these car makers who have all over the last couple of years been pushing their own version of ADAS, which is advanced driver assistance software, but also self-driving. They've been pushing it, they've been developing it, they've been putting a lot of R&D into it. But again, more recently, there was this accident by the Xiaomi SU7 that killed 3 people. That has really put the focus on safety of these self-driving technologies to the point where authorities are saying you can't call it self-driving anymore because it might encourage people to take the hands off the wheels. And let's face it, we're not at that level yet of autonomy. So there's going to be more regulation on that front, also on the battery front as well. Lithium-ion batteries have a propensity to have this thermal intensity that could lead to fires. So authorities, regulators are looking at trying to basically limit the ability, and the testing must be much more stringent on these lithium-ion batteries so they do not necessarily catch fire while people are driving in them. That's one reason why we saw CATL, the big battery maker, just 2 days ago on Monday, unveil their advances in sodium-ion batteries, which are less energy intense, less propensity to catch fires. But because of their less energy intensity, they do not have the range. But CATL is essentially saying their range is coming up. Their technologies are getting better. They're safer. We'll have to see how that technology develops, obviously. Many issues here in the domestic NEV market to counterweight, if you will, all the noise about tariffs.
Steve, thank you so much for that report. Steve, stay dry. Stephen Engel there joining us from the Shanghai Auto Show. And stay tuned to our coverage. Of course, we'll be speaking with Geely's VP of Design, plus an exclusive with Pony AI CEO James Peng. We have more ahead. This is Bloomberg. And here's the latest from the corporate front. Bloomberg has learned that a group of private lenders led by Apollo and Blackstone are giving a $4 billion loan to support Thoma Bravo's deal to buy Boeing assets. Sources say the 7-year financing will carry a rate of 4.75 percentage points above the benchmark rate. Boeing agreed to sell its flight navigation unit and other digital assets to Thoma Bravo for $10.6 billion. Regeneron has agreed to pay Fujifilm over $3 billion over the next decade to help manufacture its medicines in the U.S. Under the deal, Fujifilm will produce drugs for Regeneron at its facility in North Carolina, which is set to begin operations later this year. The move allows Regeneron to quickly increase its U.S. manufacturing capacity amid the threat of tariffs. This is Bloomberg. A high-level Japanese delegation is set to deliver a letter from Prime Minister Shigeru Ishiba to Chinese President Xi Jinping this week. The gesture highlighting Japan's desire to balance its relationship with China, its largest trading partner, and the U.S., its sole formal security ally. It also comes as Tokyo proceeds with tariff negotiations with the Trump administration. Our next guest has served various roles in Japan's government, including Minister for Foreign Affairs and for Digital Transformation. Joining us now in the studio is Taro Kono. Thank you so much for coming in such a rainy day today.
Well, it is bad weather today.
Yeah. Do you expect at least the trade negotiations to be a little bit brighter?
Well, hopefully should be better than this weather.
Yeah. We have seen this really tough balancing act for Tokyo right now, trying to really balance Beijing on one side and also trying to really negotiate with Washington. How difficult is this position?
Well, it's not just trade. Japan needs the United States for nation security. So our position is quite different from like Europe, Australia, India. So I think we need to have closer communication with Washington all the time. And the President Trump always tried to implicate the security issue with trade issue. So we need to separate those two issues.
Are there any parts that Tokyo can give to President Trump in the security issue in order to appease Washington?
Well, President Trump sort of misunderstands the U.S.-Japan security arrangement. And this is like a deja vu. When Prime Minister Abe and I went to the White House during the Trump one, same thing happened. And Prime Minister Abe explained the situation to President Trump, and he seems to have understand. Now he's coming back. This bowling ball testing that he's talking about, our automobile safety issue. He said the same thing in Trump 1, and he understood that is a mistake, but now he's talking about again. So we need to correct his facts and numbers before we can actually do something.
Is this solely about the Trump administration, or have you seen a little bit of wavering when it comes to the U.S. security alliance? Is there a need for more collective security for one point?
Yes, during the Obama administration, U.S. let China reclaim the land in the South China Sea. It was clearly over the red line, but the U.S. didn't take any action. So that's when we start a bit worried about U.S. commitment to Asia, especially President Trump was talking about Asia pivot, but he let that happen. So we really need to make sure the U.S. commit the security in East Asia, or we need to start thinking about different or additional arrangement for East Asian security.
Could it take the form of NATO or an expanded alliance there?
Something like expansion of NATO into Pacific as well. That's definitely one option. We were supposed to have a NATO office in Tokyo, and then French President Macron opposed to that at the last minute. So we really need to restart that arrangement.
If that's the case and we need more regional security as well, would it make sense for Tokyo to compromise with Washington if one of the demands is actually enacting some trade barriers against China?
Well, we shouldn't mix security issue with trade issues. That would show the weakness to China or Russia, North Korea. Even during the height of the trade war back in the 80s, it was two different issues, and that's how we treat it, how U.S. Washington treated. So I don't think we should mix two things together.
Does that mean that it would be okay to enact some trade barriers against China?
The issue with China is also different. We really need to be very careful about economic security issues and the supply chain involving China. We need to be very careful. So trade issue between Japan and the U.S. is one thing, but how are we going to trade? How are we going to treat China collectively among the West is also a separate issue.
When it comes to economic issues between Washington and Tokyo, rice imports, increasing them could be on the table. That would be deeply unpopular in Japan.
Yes, well, the rice price now is quite high compared to last year, but I think the farmers are producing enough rice. It's a supply chain issue, and I think the Ministry of Agriculture is trying to take care of it. So I don't think rice import would be a big issue during this trade negotiation.
Especially with the shortage that you mentioned, right, in terms of prices actually rising for the grain. We have seen, of course, inflationary concerns across the domestic economy as well. One of the factors was a weakening Japanese yen. And I remember last time we spoke, you mentioned that we actually needed a stronger yen. Are we kind of there now with the appreciation recently?
Well, yesterday it hit higher than 140. I think it was like first time in
since
half a year.
September or something.
So I think that President Trump won weak dollar.
Yes.
And weak dollar means yen's going to appreciate. So I think the market will fix exchange rate accordingly.
Without the Bank of Japan necessarily having to do anything this time?
The Bank of Japan is thinking about interest rate, obviously. That would probably come later this year. But right now, 140. If it's stable, I think the Japanese economy could take that.
Tell us a little bit about the Japanese economy. We're seeing about surveys of 10% of companies right now already sort of feeling the impact of the tariffs. When you talk to the Japanese public on the ground and small and mid-sized businesses, what are they feeling?
Yes, they are worried about because the SME usually supply parts to like bigger company like Toyota, which export product to United States. So the tariff would affect indirectly all the SMEs in Japan. So they are quite worried about the situation, especially they are trying to raise the wage. But if this tariff issue push down their profit, then they don't have money to give to the employees. So all the, I think the businessmen quite worried about this instability or unpredictability.
Yeah.
If they know what's coming, they can be prepared for that. But right now, we don't know what's coming tomorrow.
I think the whole world right now is
right.
very much surprised at what's happening in the global environment. But when it comes to the Japanese trade delegation trying to negotiate with the United States, we have been sort of going through some of the things that could be on the table. The government seems to think that perhaps U.S. Treasury holdings shouldn't be a part of the negotiating tools. What do you think policymakers should keep in mind when going to President Trump?
Yes, we definitely need to finish this negotiation, but we shouldn't rush in. The President Trump could flip according to how the market react to it. And what he's quoting, the facts, numbers, quite wrong. So we need to first correct his misunderstanding to put our proposal on the table. So yes, it's important to finish the talks, but we shouldn't rush in. And we need to have President Trump get the right facts and number to start from.
Taro Kono, always good to see you, and thank you so much for coming in on a very rainy day here in Tokyo. The former Japanese Foreign Affairs Minister and Digital Transformation Minister, he's headed now to the National Assembly in just a few minutes. This as we continue to watch the impact when it comes to these tariffs on the global economy. The IMF has slashed its world growth forecast for this year and next, citing risks from a global trade war. Managing Director Kristalina Georgieva also told Bloomberg that the chances of a global recession will rise if uncertainty over tariff policies drags on. She spoke to us on the sidelines of the IMF's annual spring meetings in Washington.
Trade is an engine for growth. And what we see these days is that when trade goes backwards or slows down, that has implications for global growth. As you know, we just projected the growth expectations for 2025. We are downgrading by 0.5 percentage point from 3.3 to 2.8%. Our forecast for the world, we are downgrading our forecast for almost all countries, including the United States, as a result of trade tensions.
Yeah, one thing that in that world economic outlook, you put the chance of recession in the United States up to about 40% from 27% back in January when you first published it. If the tariffs stay as they have been proposed from the United States, do you expect that chance to go up materially?
This is based on the announcements of tariffs that have been then suspended, but not for China. So it's a complicated story. But the short answer is that we are operating at a time of very high uncertainty. If we see faster resolution of trade tensions, that would possibly lift up projections for global growth, great for investors, great for families. If, however, we do not succeed and uncertainty remains very high, tariff problems hang on our head for much longer, then we actually can see even further reduction in global growth, and then the danger of recession looms bigger. What is our advice? Please talk with each other, find a way to resolve differences, and above all, reduce uncertainty. Uncertainty is bad for business.
And I think a lot of people have raised that issue. There has been speculation, including by this administration, that the United States could potentially even withdraw from the IMF. Do you see that as likely or possible? Do you have contingency plans for that?
We have very good relations with the United States. We have traditionally worked very closely with each and every U.S. administration. We have now established relations with this administration. The United States is carrying out reviews of its participation in international organizations. This is very fair. They have the right as a member to look into the mirror and say, do we have value from participation at the IMF? And I can tell you, I'm convinced that they look at this and they say, yes. Why? First, we are the only institution that can rescue countries in trouble. There are many countries that the U.S. cares about, that the fund is there to help them in a moment of high trouble. Two, we are the only financial institution, Lisa, that is like a savings bank. The U.S. puts money, we lend, then we give it back to the U.S. with interest. The last 2 years, we have paid $3.1 billion in interest to the United States. So, you know, the concern is, are taxpayers of the United States paying? In the case of the fund, no. And three, we are promoting things that the U.S. cares deeply about. Private sector-led growth, discipline, transparency, accountability. And I think for all these reasons, and also let me not forget, where are we? We are sitting with you 2 blocks from the White House. I think that the outcome of this review for the IMF would be, yes, great institution, we stay.
IMF Managing Director Kristalina Georgieva speaking with Bloomberg's Lisa Abramowitz in Washington. Some of the other stories that we're following at this hour, officials say trade talks between the U.S. and Thailand due to start Wednesday have been postponed. The delay comes after Washington asked Thailand to address certificate of origin misuse and currency manipulation. No date has been set for resumption of negotiations. Prime Minister Narendra Modi has cut short his trip to Saudi Arabia after gunmen killed as many as 26 people in India's northern Jammu and Kashmir region. The Press Trust of India says the attackers opened fire on tourists and 2 foreigners were among those killed. U.S. Vice President J.D. Vance is currently visiting India and described the attack as horrific, while President Trump offered full support. French President Emmanuel Macron is considering dissolving parliament and holding snap elections within the next few months amid a swell in his popularity. Sources say he discussed such scenarios in recent weeks, but no decision has been made. Legislative elections are not due until 2029. Macron's approval ratings have bounced as he's led efforts to respond to President Trump's tariffs. It's a little bit of a risk-on session today in the early Asia trading morning. So we're seeing the yen lose ground against the U.S. dollar by 0.8%. But this, of course, after topping 140 overnight. We have seen 3 weeks of gains against the greenback already. Gold also has lost a little bit of that bounce back that we saw after that incredible rally that topped it above that $3,500 level at one point for the first time. Nearly a 10% rally already in the month of April. Bitcoin also seeing gains of more than 2.5%. It's actually rallied above that $90,000 for the first time since early March, perhaps beginning to decouple from U.S. risk assets. Of course, we have seen the slumping dollar also adding to those moves, and speculation and hopes that President Trump will bring back more details on that strategic Bitcoin reserve. This is Bloomberg. China's purchases of US LNG plunged to zero in March after a sharp decline in the previous 2 months as the trade war between the two biggest economies alters shipping routes. Let's get the implications for the energy markets from Bloomberg NEF analyst Daniela Lee. Daniela, we have seen Beijing, of course, just stop US LNG imports starting in February. But how long will it be able to sustain this? And what sort of changes can we actually see in demand and consumption trends?
Good morning, Shery. Yes, I do think China is more than able to survive without US LNG, and the pause on LNG imports from the US could last for longer. First reason, China has other natural gas sources that are cheaper and probably more reliable, such as domestic gas production and pipeline gas imports. We still expect these two gas sources to increase, maybe although at a slower rate because of weak consumption. So here comes the second reason. Gas demand is expected to be weaker than our previous projection. And after accounting for the US tariff shock, we only expect marginal growth in China's natural gas consumption this year. And LNG imports going to take the biggest hit, squeezed by other two gas sources. China may end up only importing 67 million tons of LNG this year, 9 million tons, or 12% lower year on year.
So let's dive deeper into the consumption side of things. So which sectors will be the most impacted by the tariffs on China?
Well, I think industry will be most heavily impacted, followed by power sector. Let's first take a look at the GDP. So if U.S. tariffs on China remain as high as above 100%, almost all Chinese exports to the U.S. will be wiped out. In this case, around 2.8% of China's GDP is at risk. And this is not the only impact. China has relocated industries from clothing to solar panels to countries like Vietnam, Mexico, to circumvent some trade barriers to exports to the U.S. If you also take these into consideration, then GDP at risk can rise above 3%. But the elimination of China's direct exports to the U.S. could only cut industrial gas demand by around 2% year on year. The decline is not as severe as the GDP at risk because top gas consuming industries, as we've seen in the table, have relatively low exposure to U.S. exports. Only sectors like textile, footwear are more vulnerable to the loss of U.S. exports. But of course, if U.S. tariffs significantly lower domestic demand, then all industry sectors will be impacted. And this will also impact gas demand from power sector. But such collateral damage to power demand may be less pronounced because we expect gas power installed capacity to see record expansion in 2025, which can absorb some of the impact.
What's the worst case scenario here when it comes to LNG demand?
So the base case scenario I elaborated assumes the above 100% tariff remain in place for 6 months. But if it lasts for the whole year, then additional 3 million tons of LNG could be taken off the balance. China may lose its title as the world's #1 LNG importer.
BNEF's Daniela Lee there with the latest on energy consumption across China and, of course, the implications of this trade war. We have more ahead. This is Bloomberg. It's time now for morning calls ahead of the Asia trading day. Societe Generale sees global investors' rotation out of American assets going on for years if President Trump persists with his trade policy. Head of asset allocation Alain Bokobza believes the financial dominance of the U.S. is being challenged. Bokobza was U.S. asset bull for a year until September 2024, when he warned of cracks appearing, perfectly timing the unwind of so-called U.S. exceptionalism. But Nomura is betting big on the U.S. market rebound, backing that up with a $1.8 billion deal. Investment management chairman Christopher Wilcox tells Bloomberg he's optimistic about deal-making prospects despite short-term volatility. The Japanese brokerage is acquiring Macquarie's U.S. and European public asset management business in its biggest overseas acquisition since 2008. The Barclays CEO says the dollar will absolutely remain the world's only reserve currency, despite the upheaval caused by President Trump's tariffs. Speaking at Bloomberg's Sell-Side Leaders Forum, CS Venkatakrishnan said that the dollar has too long a track record to easily move away from it.
It's 100 years, 80 years, 100 years of dollar strength. So much so that important commodities, gold, oil, are denominated in dollars. Dollars are part of the payment system. When countries talk to each other, they represent their GDP and various figures in dollars. I think undoing that will take a long, long time. And, 3% in foreign exchange terms is not that much.
And of course, we're gearing up for trading starting in Australia, Korea, and Japan. And these are some of the stocks that we'll be watching. Suppliers for Tesla. We've seen that huge rally in the after-hour session after it reported first quarter earnings. We heard from Elon Musk saying that he'll pull back significantly from his commitments with the U.S. federal government starting in May, and that he'll be actually allocating far more of his time to Tesla. Of course, we know that Tesla actually missed when it comes to profit, adjusted earnings of 20 cents per share for the first quarter. The stock is still down 41% this year. This was the last close for those suppliers for the company. We'll be watching these stocks at the open. We have the market opens in Sydney, Seoul, and Tokyo next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens after a rally overnight. Paul, we had more positive headlines when it comes to tariffs, but also we heard from President Trump that he has no intention of firing Fed Chair Powell.
Yeah, that's right, Shery. What a difference today makes. It was only 24 hours earlier that the word termination was being kicked around, and now no intention to fire Jay Powell. Certainly, markets welcomed that news, but good news though it is for markets, it does reflect this ongoing uncertainty around policy that comes out of the White House.
Yeah, I mean, that was the uncertainty around perhaps the U.S. central bank independence, that we saw a lot of assets and capital just veering away from the U.S., especially with the dollar sinking to that 15-month low. Well, we're seeing a little bit of a rebound right now early in the Asia session, and that's actually pressuring those currencies on the other side of that trade, with the Japanese yen now weakening towards that 143 level. And remember, overnight, we actually topped 140, and we haven't seen that sort of strength in the Japanese currency since September. The Nikkei also gaining more than 1.5% alongside the topics. On a very significant week for Japan, of course, we do have trade negotiations ongoing in Washington, the finance minister meeting with Scott Bessent, not to mention that over in China, another delegation from Japan delivering a letter from Prime Minister Ishiba to President Xi Jinping. Also, trade negotiations, very important for South Korea. Take a look at how the Kospi is coming online. We had seen some pressure for the Korean won even in the previous session. We continue to see that weakness with that 14.29 level against the greenback, but some gains when it comes to the Kospi and the Cossack. Seoul and Washington also starting their first round of trade negotiations on Thursday, Paul.
Yeah, let's take a look at how we're tracking at the open here in Australia as well. Got a very positive start, perhaps not unexpected. We're better to the tune of about 0.5% right now. It is, of course, a staggered open, but that's a pretty big move considering not that many stocks are trading as of yet. Seeing some gains for the Aussie dollar as well. Of course, the Aussie closely linked to the fortunes of commodities, so perhaps a little bit of optimism spilling over into the currency there. Not a huge amount of movement on bonds, on Aussie bonds at least, but if we take a look at the yield on the 10-year, that was an interesting one to watch as well, because we were parked at 4.40. We're seeing that yield pulling back a little bit since the open, and of course we did have Trump making those remarks on Jay Powell. Let's take a listen.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. If he doesn't, is it the end? No, it's not. But it would be good timing. She could have taken place earlier. But no, I have no intention to fire him.
Right, let's bring in Rupal Agarwal now, Director and Senior Research Analyst at Bernstein. And Rupal, I want to start with that apparent reversal on Jay Powell, because it was only 24 hours earlier, as I mentioned, that President Trump had used the word termination on social media platforms. It also follows on from a change in tone on China and tariffs from Scott Bessent, the Treasury Secretary, and that follows on for the 90-day reprieve that we saw on the global tariffs after markets in the world of President Trump got yippy. So what are we seeing here? Are markets discovering that they can dictate U.S. policy now?
I think it just highlights that there is just too much uncertainty, and the headline risk is back on the table. That's one of the key challenges we see, is there in the market right now. Investors are really grappling in terms of how to deal with not just the political uncertainty, but also the macro uncertainty. And of course, we don't yet know in terms of how much of these tariffs are going to stick around. We don't yet have enough details to understand where the trade deals are happening, what that entails for different economies. So I think all this just further highlights that things can change very quickly, and it's very difficult to actually change portfolios on a daily basis.
In that regard, though, when you see some of the gains that we're seeing on equities globally today, does that give you some confidence that at least we can say, well, maybe the floor is in, and do you look at dip buying opportunities?
We definitely see dip buying opportunities. And in fact, that is something that we have been recommending to investors, at least in Asia. But I would still say that it's not happening across the board. So it's more around markets where, maybe the valuations have come down to reasonable levels. The earnings trends are looking relatively better. And there is some expectations that the deal is going to be made sooner than later. So, for example, across Asia, we like markets like India. We've also been positive on Japan and Korea. So those are the three big markets where we think that dips should be bought.
Why Korea? I understand India because there's been a lot of optimism that perhaps they're a little bit insulated from this ongoing trade tensions, but South Korea seems to be very much exposed.
I absolutely agree. So yes, it's quite against the natural, portfolio allocation that one would have right now, which is essentially aligned to more domestic-oriented economies. Korea has been our preferred market since the beginning of the year. And that's largely been driven by, these earnings revision trends in terms of a recovery cycle that has started emerging since the beginning of the year. And as we've progressed through the year, more and more sectors are actually participating in that earnings recovery. Now, of course, one can always question in terms of how much you can really rely on these, earnings numbers, because there is still a lot of uncertainty, and I hear that. But I would still say that, it's not easy to align portfolios with all this flip-flop on policy. So it's better to align portfolios with where the earnings trends have been relatively positive, at least till the end of last month. And as we progress through this month, we'll get more clarity. So on that front, we like Korea.
Is that also the case for Japan? Because when it comes to flip-flopping, I mean, it's very difficult to tell where the Japanese yen will go.
See, Japan is a market that I've always liked more because of all the structural reforms that we are seeing. And, this big regime shift that we've seen in Japan from a macro perspective and, of course, from a policy perspective. I would say Japan looks better even right now because, we've always liked the idea of looking at Japan domestics. And in this environment, Japan domestics look even more attractive because, again, all the reforms are ongoing. Plus, you are basically hedging the portfolios from all the tariff uncertainty. In terms of yen, I would say that, if you look at the non-commercial net long position on yen, it's actually at record highs. We've never seen those kind of levels. So there is expectation that there's going to be some, weakness in yen in the near term.
I just want to get your views as well on some of the rhetoric that we've heard from the Treasury Secretary Scott Bessent about the potential for a possible US-China trade deal. Does this give you some optimism when it comes to Chinese markets as well?
Absolutely. So on China, it's still quite uncertain. Things can change very quickly. I think the view that we have on China is most investors are still quite underweight China. So this is clearly not the time to further increase your underweight. Hold on to your Chinese positions. You need to, of course, sort of recalibrate in terms of what you're holding. So right now, the recommendation from our side is look at Chinese domestic consumer names, high quality names. They've been doing well. They're likely to continue to do well. You have, one part of the portfolio which is relatively defensive, but at the other side, you stick to your growth names. So it has to be a barbell position in China because what we heard, for example, yesterday, could actually speed up and hence, bring back a lot of your, sentiment, which is quite bearish when you look at China.
Rupal Agarwal, really good to have you with us, Director and Senior Research Analyst, Asia Quantitative Strategy at Bernstein. And of course, as we continue to watch the markets, those suppliers for Tesla are some of those stocks that we'll be keeping an eye on, because look at that, early in the session, but we're already seeing big gains. Tesla in the after-hour session gaining more than 5%, as you can see there. We got the first quarter earnings. Yes, profit missed, but at the same time, Elon Musk now saying that he'll be pulling back significantly from his commitments with the U.S. government, and he'll be allocating far more of his time to Tesla. Still, we have to put into context, Tesla is down more than 40% this year already, Paul.
Well, let's take a look at BHP as well. This is one of the giants of the Australian Stock Exchange, better by 2.6%. A couple of things going on here, not the least of which BHP said to begin preparing a succession process for the Chief Executive Officer, Mike Henry. Mike Henry has been in the role since the start of 2020, so 5 years in the job. BHP now looking at a potential successor there, and also perhaps the news that there might be a bit of relief coming on that US-China trade front, also pushing shares of the big miner higher. We've got more ahead on the Asia trade. This is Bloomberg.
We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high. I think we'll make a deal with China.
President Trump on his hopes for a trade deal with China. Our China correspondent Min Lo joins us now from Hong Kong. I mean, Min, what does being very nice with China even mean? Where are we in these negotiations?
Yeah, so reporters actually asked President Trump, will he play hardball with China? And he said no. And this is really an interesting turn of the narrative here. President Trump saying that the final tariffs for China will be quite far away from, well, will not be near to the 145% tariff so far, but it won't be zero as well. He says China will be very happy with the final deal, but they have to make the deal. And then he said if China doesn't, then the U.S. will set the deal. So certainly the window for that potential deal seems to be opening up just a little bit wider. And this comes as Scott Bessent, the Treasury Secretary, also said in a closed-door investment summit hosted by JP Morgan Chase that this standoff between U.S. and China is not sustainable. And he said both sides will have to find a way to de-escalate. And the timing, he said, is going to be in the very near future. Although he cautioned that any sort of big comprehensive deal is going to take a long time, possibly 2 to 3 years to iron out. And he continued to reiterate the contention that China is favoring its own manufacturing at U.S. expense. So any deal will have to rebalance trade and bring manufacturing back to the U.S. But again, look, President Trump has been known to eat his own words. We look at what he had said about Jay Powell recently. So it's really hard to discern sometimes whether it's just a throwaway comment to shore up markets, or is this really a shift in his stance and his openness to strike a deal with China?
Let's move on to some more solid ground, Min Min. The IMF lowering its global growth forecast. China expected to contribute a bigger share to global growth. What are they saying?
Yeah, so IMF has lowered the global growth forecast by about 0.5% down to 2.8% this year, which is the slowest since the pandemic year of 2020 and the second lowest since 2009. But their calculations show that China will be the biggest contributor to global growth this year. About 23% of growth expected to be coming from China versus just about 11% from the US and about 15% from India. But still, it is that big overhang of these tariff and trade war that is likely to cause inflation and prices to go up. The recession risk in the US, according to IMF, has gone up to 40% this year. So it is going to spill over to consumers. But yes, all eyes on how China will inject more stimulus to support the economy to counter some of that tariff impact.
All right, China correspondent Min Min Lo in Hong Kong. The 21st Shanghai Auto Show begins today with the Trump tariff war hanging over an industry already grappling with a slowdown in demand as it transitions to electric vehicles. Our Chief North Asia correspondent Stephen Engel is at the venue, joins us now. Steve, with, as Min Min was describing, some potential talk of tariff relief coming between US and China. What's the mood on the ground there in Shanghai?
Well, that would surely be welcome news to the participants in the halls behind me. There's no lack of enthusiasm here for the Chinese new energy vehicles, obviously. But again, those car makers who do, let's face it, have excess capacity because there is a slowing Chinese economy, clearly, and those secondary markets, which are now becoming sort of primary markets. I'm talking South America, Africa, Southeast Asia, Middle East, and other places other than the United States and Europe. They basically used to be, in the pipeline to eventually go to the United States. Now it's more of a pipe dream because, again, 145% tariffs on all Chinese exports, including EVs and other auto parts, is just not sustainable for them to have a viable business in the United States. That's why you're already starting to see the Chinese and the Europeans begin discussions about possibly a minimum price mechanism rather than tariffs. And clearly, all the automakers that I'll be speaking to over the next few days will be talking about their available markets. Like I said, Southeast Asia will be critical, as well as South America, Africa, and the Middle East. That's going to be a big push. But also, again, you have to look at the makeup of this domestic market right now, because in years past, I've covered so many of these different auto shows. They alternate between Beijing and Shanghai. It used to be dominated by the foreign players, which up until 2020, the foreign car makers had about 60% of the market share here. They're now down to about 32%, so about half what it was in 2020. GM, Ford, very minimal presence here. Tesla is not even here. And the Europeans, like Volkswagen, Mercedes, BMW, they do have a large presence here, but their market share is also dwindling. If you look at the new energy vehicle top 10 list, according to Automobility, there's only one foreign player in that top 10. At the top is BYD, the overwhelming dominant player. Tesla is the only one in the top 10 of foreign automakers. The rest are all Chinese players. And that's going to lead potentially to an eventual shakeout. But right now, everyone's trying to grab market share in a booming EV market, which is essentially leading the world in new energy vehicles.
Yes, Steve, I mean, we've talked a little bit about the potential external challenges, but domestically, these automakers also face many challenges, right? I mean, you talked about the NEV market, but also perhaps some issues with the autonomous vehicle drive.
Yeah, that's right. So China was a great test bed, has been, and it still is a great test bed. There's pilot zones all across China, whether it's in Shenzhen or Guangzhou, Beijing, outskirts of Shanghai, test zones for essentially autonomous driving. But that's also become kind of a negative buzzword, according to the regulators, who are really now stepping up their scrutiny following that high-profile accident a few weeks ago of that SU-7 from Xiaomi, that essentially a half hour or thereabouts announced before it crashed at high speed, killing 3 people, the autopilot essentially had been switched on. So there's lots of scrutiny about safety. The regulators, the MIIT, information and technology regulators, essentially looking at clamping down on the ability of these car makers in the halls behind me to essentially call assisted driving self-driving, because that's led to a perception that you can take your hands off the wheel, and that potentially, the investigation is still ongoing, that potentially led to that accident with the Xiaomi SU7. So again, that's going to be in high focus, as well as battery safety and the thermal intensity of lithium-ion batteries. That's why you saw a company like CATL on Monday say they've made great strides with sodium-ion battery technology. It doesn't have the same energy intensity, so it didn't have as much range, but it was much safer. It did not have the ability, like those lithium-ion batteries, to essentially catch fire as quickly. So again, there's a lot of regulation coming into a sector here in China that essentially is leading the world and also powering ahead with lots of innovation that is going to be featured in the halls behind me over the next week and a half.
Bloomberg's Stephen Engel there with the latest coming from the Shanghai Auto Show. And of course, we'll be watching those auto suppliers during the trading session today. Big moves, especially to the upside, given that we heard from Tesla. I mean, Steve talked about some of those challenges in China, but we heard from Elon Musk that he'll be significantly pulling back from his commitments with the U.S. government, and we saw Tesla stock rallying in the after-hour session. This despite actually missing on the profit. For more on Tesla, let's bring in Bloomberg EV reporter Kara Carlson. Kara, I mean, you could essentially hear investors cheering this idea that Elon Musk will be actually returning and spending more time at Tesla.
Yes, so that was the big takeaway, and it honestly opened the call up. This is something investors have been listening for and hoping for. There's been a lot of backlash and brand damage and just overall concerns that Elon Musk is not putting enough time into Tesla. So when he said today that he was going to step back, he will still be involved with the Trump administration to some extent and refocus more on Tesla. We did see the shares surge a bit. This is something we've been expecting to some extent. He is limited to 130 days in his current role at the Department of Government Efficiency, but it was welcome to news.
And Kara, what do we hear around the outlook for Tesla? Is it even possible to forecast accurately in this environment of trade uncertainty and beyond cars in terms of autonomous robots and the like?
Yeah, so Tesla did scale back its outlook a bit. We're expecting a new update in the second quarter. They've been saying they're going to return to growth this year after missing vehicle delivery growth last year annually. Now they're kind of measuring that back a bit. They're saying they're expecting impacts from tariffs, and you know, they didn't directly say they're not going to grow, but it was not as clear cut on either direction yet. And so we'll be expecting a new update next quarter. They did confirm they were on track for robotaxi and rolling out some more affordable vehicles this year. Robotaxi would come in Austin in June before other markets. So they did confirm some of the timelines that they have been reiterating, but a lot of it murky waters ahead.
Anything specific on markets, especially the likes of China?
Not a lot of specifics given other than the June Austin robotaxi date.
All right, Bloomberg's Kara Carlson there. Thanks so much for joining us on those Tesla results. And stay tuned to our coverage of the Shanghai Auto Show. We're going to be speaking with Geely's VP of Design, plus an exclusive with Pony AI CEO James Peng. More ahead on the Asia Trade. This is Bloomberg. Well, let's get to some market calls that we're following today. Societe Generale sees the global investors' rotation out of American assets going on for years if President Trump persists with his trade policy. Head of Assets Allocation, Elaine Bakobza, believes the financial dominance of the U.S. is being challenged. Bakobza was a U.S. asset bull for a year until September 2024, when he warned of cracks appearing, perfectly timing the unwind of so-called U.S. exceptionalism. But Nomura betting on a big rebound in the U.S. markets, backing that up with a $1.8 billion deal. Investment Management Chairman Christopher Wilcox tells Bloomberg he's optimistic about deal-making prospects despite short-term volatility. Japanese brokerage is acquiring Macquarie's U.S. and European public asset management business, and that is its biggest overseas acquisition since 2008. Shery.
And Paul, we have breaking news out of Intel. Intel expected to announce plans to cut over 20% of its staff to eliminate bureaucracy and rebuild an engineering-driven culture. This, according to people speaking to Bloomberg. The move is part of a bid to streamline management and rebuild an engineering-driven culture, according to the person. It will be the first major restructuring under the CEO, Lip-Bu Tan, who took the helm last month. So we're hearing now that Intel is expected to announce plans to cut over 20% of its staff. And remember, these cutbacks would follow an effort last year to slash about 15,000 jobs, and also coming as Intel aims to spin off non-central assets. We have more ahead on the Asia trade. This is Bloomberg. We have breaking news out of Japan. We are getting the latest PMI numbers. Manufacturing coming in at 48.5, preliminary numbers for the month of April. Services above the contractionary territory of 52.2. Also, the broader composite, 51.1. So we had actually dipped into contractionary territory in the month of March. We're coming out of that. So Japan PMI composite for the month of April, the preliminary numbers coming in above that 50 threshold. Of course, we continue to get these PMI numbers not only from Japan, but also from the U.S. Europe will be watching them very closely. We had Australia already in expansionary territory earlier today. Really, the first signs and indications of how Trump's tariffs are really affecting the broader manufacturing and services activity around the world. Take a look at how emerging market currencies are trading at the moment as well. We have seen the U.S. dollar rebound after that significant weakness when it fell to that 15-month low. So when it fell to that 15-month low, we had on the other side of that trade, Latin American currencies really leading the rally. Right now, we're seeing a little bit more pressure given that the U.S. dollar is now making a comeback. Of course, this coming at a time when we've also heard from President Trump saying that he has no intention of firing Fed Chair Jerome Powell. So perhaps a little bit more conviction in the markets today. Also a little bit of more of a risk-on session today across Asia. Let's bring in our next guest to seize opportunities in EM debt markets with high-quality issuers and sectors offering stable revenue streams. With us now is Jeff Grills, head of U.S. cross markets and EM debt at Aegon Asset Management. Jeff, always good to see you. So we saw this really flight from U.S. assets, investors' confidence being hit after these talks about not only tariffs, but President Trump really criticizing Fed Chair Powell, the independence of the U.S. Central Bank. Where will this rally in EM debt that we've seen already this year, especially with local currency debt, go from here as we continue to see this skepticism about the U.S. markets?
Yeah, thank you very much for having me. With regard to EM local investments, they started this year actually from a pretty good starting point. The big benefit that EM local currencies have had is that central banks have actually been implementing countercyclical monetary policy. So they've been raising rates for the last 2 years, and a number of countries started with double-digit yields: Colombia, Mexico, South Africa, and that's the more stable currencies. You also have Nigeria and Turkey. So we already have seen flows going into EM local. $3 billion has gone in this year. And since this Trump tariff has been going on, We've seen the general weakness in the U.S. dollar, which has also boosted local currencies. And we think for the most part that will continue, with the exception of maybe Asia, where depending on where tariffs fall out, you could see Asian currencies be a little bit weaker if they need to adjust to higher tariffs.
I was going to ask, where does Asian countries really rank relative to other EMs, especially Latin America, given, of course, the tariff risks? Are there safer parts of a debt that we could see across the region that you could take really, you could really hide out in this moment of volatility?
Yeah, I do think there are going to be the relative winners even within Asia. So India, which is not as easy to access, but India, we think, is going to be the biggest beneficiary of all of the tariff policy that's going on for local currency, but also on the U.S. dollar side for corporates. Other more stable currencies like Indonesia, Malaysia may do well. I think once you get outside of that, we tend to shift towards Latin America and African countries as being the general winners in this. And the other thing I would note is that the one advantage that the countries, at least away from the Asian region, are starting with much higher real yields, right? So in Brazil, you have yields that are in the double digits, close to 13%. They were as high as 15%. Even in Mexico, you have 11% type of yields. So I think that the marginal outperformers will be, or at least the outperformers will be those currencies, just given the combination of yields and likely some FX appreciation to continue as they get lower tariffs likely going forward.
Jeff, I couldn't help but notice absent from that list was China. What is your view on Chinese debt at the moment?
So there has been always this talk about, will China need to do some sort of a depreciation of their currency? That we don't think they're going to have a strong depreciation. We think that they will need to do some sort of modest loosening and letting a gradual depreciation go on in their currency. They don't really want that. They're trying to fight. They're trying to keep, their policy rates pretty stable. They want to start to see inflation coming back up, so that may actually help them a little bit depending on what happens. But China's just an unknown, right? We don't know how this is going to resolve. We saw the comments from Bessent today coming out of Washington, D.C. saying that they should be an ability to have some sort of a trade deal. There should be an ability to that this is just not sustainable. We just don't know when. So for us right now, China is just one, and the Asian region one, from a currency perspective, that we'd rather be patient and wait and see how this resolves. And if there is a resolution, as I pointed out, I think that the rest of the market will continue to do very well.
And on the subject of currencies, do you think we saw a floor put under the US dollar today with Trump's reassurance that Jay Powell's not going to get fired?
Yeah, that's going to be a big question mark, right? Because I do think this administration has really done the ebbs and flows for the entire time they've been in office since January. So clearly that's a positive. We don't want to see any sort of disruption from that perspective. The bond market signaled that when there was some uncertainty or some unease with some of the comments out. So a floor, I don't know that necessarily this will be the floor. It could be. But I do think that we're not out of the woods, right? I mean, we still have to get to past the 90-day tariff pause. We need to see some more positive signs that there actually are trade deals that are being negotiated to give the confidence. I think if you do start to see some positive trade negotiations, something with Europe, something with Japan, that probably would indicate that we might have seen the lows. But we do because we would expect that there is some depreciation of some of these currencies. But again, the uncertainty is still with us, and we just don't know. This administration loves to keep things off balance if they can.
Yeah, given all of that, we have seen really gold rising to record highs. That's one sector that you're liking, aside from really the stable utilities and other names?
It is, right? I mean, I think that the gold trade is here to stay. We do think that with investors looking for potential alternatives to the U.S. dollar and treasuries as a safe haven, our expectation is that gold will continue to rise. And you do get certain countries within the emerging markets. The gold corporates that you can invest in generally trade at much tighter levels. Gold has been on a tear for the last 3 years. But when you get to some of the other ones, Kazakhstan, Uzbekistan, they get some benefit from gold. And then Ghana's one that's a little interesting, typically sometimes associated with oil, but they've been really increasing their production in gold. And we think that that's going to benefit a country like Ghana as well, which has very wide spreads and high yields today.
All right, Jeff Grills, head of US cross markets and EM debt at Aegon Asset Management. Thanks so much for joining us. Well, the International Monetary Fund has slashed its world growth forecast for this year and next, citing risks from a global trade war. Managing Director Kristalina Georgieva also told Bloomberg that the chances of global recession will rise if uncertainty over tariff policies drags on. She spoke to us on the sidelines of the IMF's annual spring meetings in Washington.
Trade is an engine for growth. And what we see these days is that when trade goes backwards or slows down, that has implications for global growth. As you know, we just projected the growth expectations for 2025. We are downgrading by 0.5 percentage point from 3.3 to 2.8%. Our forecast for the world, we are downgrading our forecast for almost all countries, including the United States, as a result of trade tensions.
Yeah, one thing that in that world economic outlook, you put the chance of recession in the United States up to about 40% from 27% back in January when you first published it. If the tariffs stay as they have been proposed from the United States, do you expect that chance to go up materially?
This is based on the announcements of tariffs that have been then suspended, but not for China. So it's a complicated story. The short answer is that we are operating at a time of very high uncertainty. If we see faster resolution of trade tensions, that would possibly lift up projections for global growth, great for investors, great for families. If, however, we do not succeed and uncertainty remains very high, tariff problems hang on our head for much longer, then we actually can see even further reduction in global growth, and then the danger of recession looms bigger. What is our advice? Please talk with each other, find a way to resolve differences, and above all, reduce uncertainty. Uncertainty is bad for business.
And I think a lot of people have raised that issue. There has been speculation, including by this administration, that the United States could potentially even withdraw from the IMF. Do you see that as likely or possible? Do you have contingency plans for that?
We have very good relations with the United States. We have traditionally worked very closely with each and every U.S. administration. We have now established relations with this administration. The United States is carrying out reviews of its participation in international organizations. This is very fair. They have the right as a member to look into the mirror and say, do we have value from participation at the IMF? And I can tell you, I'm convinced that they look at this and they say, yes. Why? First, we are the only institution that can rescue countries in trouble. There are many countries that the U.S. cares about, that the fund is there to help them in a moment of high trouble. Two, we are the only financial institution, Lisa, that is like a savings bank. The U.S. puts money, we lend, then we give it back to the U.S. with interest. The last 2 years, we have paid $3.1 billion in interest to the United States. So, you know, the concern is, are taxpayers of the United States paying? In the case of the fund, no. And three, we are promoting things that the U.S. cares deeply about. Private sector-led growth, discipline, transparency, accountability. And I think for all these reasons, and also let me not forget, where are we? We are sitting with you 2 blocks from the White House. I think that the outcome of this review for the IMF would be, yes, great institution, we stay.
IMF Managing Director Kristalina Georgieva speaking with Bloomberg's Lisa Abramowitz in Washington. And the other stories that we're following from around the world. A high-level Japanese delegation is set to deliver a letter from Prime Minister Shigeru Ishiba to Chinese President Xi Jinping. The gesture highlights Japan's desire to balance its relationship with China, its largest trading partner, and the U.S., its sole formal security ally. It also comes as Tokyo proceeds with tariff negotiations with the Trump administration. Officials say trade talks between the U.S. and Thailand, due to start Wednesday, have been postponed. The delay comes after Washington asked Thailand to address certificate of origin misuse and currency manipulation. No date has been set for resumption of negotiations. Prime Minister Narendra Modi has cut short his visit to Saudi Arabia after gunmen killed as many as 26 people in India's northern Jammu and Kashmir region. The Press Trust of India says the attackers opened fire on tourists and 2 foreigners were among those killed. U.S. Vice President J.D. Vance is currently visiting India and described the attack as horrific, while President Trump offered full support. French President Emmanuel Macron is considering dissolving parliament and holding snap elections within the next few months amid a swell in his popularity. Sources say he discussed such scenarios in recent weeks, but no decision has been made. Legislative elections are not due until 2029. Macron's approval ratings have bounced as he's led efforts to respond to President Trump's tariffs. We have more ahead on the Asia trade. This is Bloomberg. European futures pointing to the upside early in the Asian session. Of course, we have a risk rally going on across Asia today, bouncing back from those losses that we saw in the previous few sessions. Take a look at the euro also losing ground against the U.S. dollar. We've heard from the ECB official, Francois Villeroy, saying that President Trump's trade policies are based on flawed economic arguments and are causing a lose-lose game for the world. He warned that President Trump's trade tirades are dampening economic growth, including in the U.S., and threatening financial stability. Of course, we already saw, Paul, that downgrade by the IMF when it comes to global growth forecasts.
Let's take a look at foreign exchange markets as well. Seeing plenty of action there again today. The yen weakening against the greenback, or is that the greenback strengthening after we heard from President Trump saying that he has no plans to fire Jay Powell? So somewhat of a reversal from some of the language that we were hearing at 24 hours earlier. So the dollar strengthening. We've also got the yuan at 7.30 at the moment. One of the currencies that's strengthening against the dollar, however, is the Aussie, now just knocking on the door of 64 cents. Perhaps some optimism here around commodities as well, with the US Treasury Secretary Scott Bessent signaling that, well, there might be some relief in store in terms of the US-China trade war. Well, let's get to Bloomberg FX strategist David Finnerty now. So, David, if we think back to those remarks from President Trump a few hours ago, can we say with any confidence that we've seen the worst for the greenback?
I don't think you can say you've seen the worst for the greenback. Certainly, you've seen a near-term correction, and that's being spurred by, obviously, President Trump's remarks about Fed Chair Powell, that he won't remove him. And with only 1 year left in Fed Chair Powell's, to be honest, it makes little sense from the market's perspective to remove him. But obviously, that's calmed market jitters down on that issue. I think going forward, though, I don't think the dollar's completely out of the trouble storm yet, shall we say. I think now you've got to focus on what the data comes out with now. So we're always focused obviously on what President Trump says and what tariff policies are, but now we're going to start getting some data, starting with the PMI data today in Europe and the US and in other countries, and that will give us a gauge. It's the first main sort of data for April that we're beginning to see, so you get an idea of how has this tariff policies beginning to impact manufacturing, the service economy, etc., etc. So if there is a divergence in growth policies between, say, the US and Europe, and it could be one outperforming the other, or that the growth differential narrowing, then that will start the market will start putting that into the equation. And obviously next week, let's not forget, we have the US payroll data coming out, which will be, as always, heavily focused, particularly the unemployment rate. And the markets at the moment, projections are they'll stay at 4.2. If it starts upticking, then remember the market's looking for 3 to 4 rate cuts at the moment from the Federal Reserve this year. If it's upticking, the market will go, well, that's data to support our case. And obviously upticks more than expected, the market may start adding to those rate cut expectations, which again could weigh on the dollar. So still uncertainty out, but I think really the focus switched now to what's the data actually signaling.
How does this all really complicate the picture when it comes to U.S. assets in general? Because we have seen sort of this sell America trade with the pressure on the dollar and just the instability in the treasury space as well.
Yeah, it's certainly become that way. You think normally in periods of risk off, the dollar it tends to be one of the better performing currencies. Obviously, the yen and the Swiss franc tend to outperform it, but then the dollar tends to do quite well. That's not been the case this time. It really has become, we had equities at one point, we had equities going down, we had treasuries going up, with the dollar weakening as well. So there was this sentiment that they said it was, for whatever the reason, and whoever was selling, it was basically a risk off trade. And I still sell a dollar trade or sell US trade, and I still think at the moment that's still there. I think that the question becomes, how does this data play out? How long are the tariffs in place? What are at the end of the day, what's the total ramifications on the global economy and the US economy? And then the question is also, but what sort of damage has been done? Even if, say, tariffs were wiped away now, theoretically saying, will the market go, yeah, but they could be brought back again? So, in terms of long term, only we'll find out, obviously, as time passes by. But is there some sentiment now, investors, that look, with this administration, that they're not comfortable as they were before, keeping their money in the US? And again, only time will really tell that. But certainly at the moment, the sentiment has been, look, it is sell at the moment overall. That's been the general trend.
And what's been sentiment overall when it comes to Chinese assets? Because we have now seen the PBOC perhaps guiding the yuan a little bit weaker given all of these trade tensions.
Yeah, I think when it comes to China, as you said, the yuan has been guided lower, particularly more against the basket than against the dollar. The dollar's been this 7.29 to 7.31 sort of range, but against the basket of currencies, which have all been obviously rallying against the dollar recently, the yuan sort of just held its ground. So it's been allowed to really focus appreciate against the basket, which obviously will help the China economy. I do think that the market is focused on what other stimulus will China provide? How will this tariff scenario play out? We saw Scott Bessent overnight saying, look, this is unsustainable, basically, what's going on with US and China. But the question is, while it may be unsustainable, how long will it remain in place? And with neither side appearing in any hurry to budge on you think it could be in place certainly for a few months and maybe longer than that. So I think the question then becomes okay, what other stimulus will China provide to support the Chinese economy? And again, that's always an ongoing thing. So at the moment, it's certainly not. I think a lot of people are undecided. The general sentiment regarding the dollar, yuan, is certainly that the yuan may be allowed to appreciate very slowly. No one expects it to appreciate very quickly, but to appreciate slowly if these trade tensions do continue to exist.
Yeah, right, financial stability being key for Beijing policymakers, right?
Yep.
Right. We have more ahead on the Asia trade, of course, as we continue to follow Japanese currencies and broader currencies as well. We continue to see that strength in the Japanese yen. This is Bloomberg.
Take a look at Intel shares rising after hours. This is after news of a Bloomberg scoop that we understand Intel is expected to announce plans to cut more than 20% of its staff to get rid of bureaucracy, also rebuild an engineering-driven culture. So the market liking that news. The move is part of the new CEO Lip Butan's bid to turn around the struggling chip maker. So these cutbacks, should they happen, would follow an effort last year to get rid of about 15,000 1,000 jobs. Intel trying to spin off non-central assets and improve its balance sheet as well. So a plan this week to reportedly cut more than 20% of staff at Intel. Shery.
Yeah, Paul, as we continue to watch those global headlines about growth projections being downgraded, of course, from the IMF, as well as really the economies around the world are digesting all of these President Trump tariffs. But take a look at how futures are setting up in trading, because really we're seeing that upside continue. We had U.S. stocks rallying in the overnight session, the best day in about 2 weeks. And Chinese A50 futures also finishing to the upside of 0.3%. That's it from the Asia Trade. Our markets coverage continues. The China Show is next. This is Bloomberg.